Negative Volume Index, NVI. The Negative Volume Index, NVI, is a technical analysis tool used to measure the strength of a trend. It compares the current period's volume to the previous period's volume. If the current period's volume is lower, the NVI increases. If the current period's volume is higher, the NVI decreases. If the NVI is rising, it may indicate the price of the cryptocurrency will continue to rise. If the NVI is falling, it may indicate the price of the cryptocurrency will fall. The NVI is a lagging indicator and should be used with other tools and techniques to form a complete trading strategy. Nick Szabo. Nick Szabo is a computer scientist and expert on digital currencies and smart contracts. He is known for coining the term smart contracts and proposing the idea of bit gold, which influenced the development of Bitcoin and other cryptocurrencies. Szabo's work has had a significant impact on the field of computer science, and he is a respected researcher and leader in the cryptocurrency community. Node. A node is a computer that connects to a blockchain network and helps validate and relay transactions and maintain the network. There are different types of nodes. Full nodes download a copy of the entire blockchain and validate transactions and blocks against network rules. Lightweight nodes rely on full nodes for information and do not download the whole blockchain, and supernodes are full nodes that handle high volumes of transactions and provide additional services to the network. Nodes also play a role in the consensus process of a blockchain, where they may compete to solve math problems to validate transactions and add them to the blockchain. This process is called mining. Nominator. A nominator is someone who helps secure a proof of stake (POS) cryptocurrency network by staking or locking up their tokens. Nominators delegate their staked tokens to validator nodes, which create and validate new blocks on the blockchain. In return for their contribution, nominators receive a portion of the rewards earned by the validator nodes. Nominators play a role in the security and decentralization of a POS network by ensuring there are enough validator nodes participating. Non-Custodial. Non-custodial refers to a system where users control their own assets instead of a third party holding them. A non-custodial service requires the user to protect their assets using a private key or other security measures. Non-custodial services are considered more secure than custodial services, where a third party holds the assets and may risk losing or mismanaging them. Examples of non-custodial services in cryptocurrency include self-hosted wallets, decentralized exchanges, and non-custodial payment processors. Non-Fungible Token, NFT. A non-fungible token, NFT, is a unique digital asset that represents ownership of a specific item or piece of content. NFTs are stored on a blockchain and cannot be exchanged for other tokens on a one-to-one basis because they are unique. They are often used to represent ownership of digital art, collectibles, in-game items, and other types of digital content. NFTs are bought and sold on specialized marketplaces and can be valuable because they are unique and cannot be replicated or counterfeited. However, NFTs are a new technology and it is important to understand the risks before buying or selling them. Nonce. A nonce is a number used once in a cryptographic operation, like hashing data. It's often used in mining to try and find a hash value that meets certain requirements. Nonces help secure the process of adding new blocks to a blockchain and prevent replay attacks. They're used only once and aren't reused. Off-chain. Off-chain transactions are cryptocurrency transactions that happen outside of the blockchain. These transactions may be faster and cheaper than on-chain transactions, but they may not offer the same level of security and transparency. Off-chain transactions include traditional bank transfers, payment processors, and centralized exchanges. On-chain transactions are those that happen on a blockchain. They are recorded in the permanent and transparent ledger of the blockchain and are validated by the network. They offer security, transparency, and decentralization but may be slower and more expensive than off-chain transactions. On-chain transactions include cryptocurrency transfers, smart contracts, and decentralized apps. One cancels the other order, OCO. A one cancels the other order, OCO, is a type of order that allows a trader to set up two orders that are linked together. If one order is filled, the other order is automatically cancelled. OCO orders are often used in cryptocurrency trading to manage risk and protect against certain market conditions. They should be used as part of a comprehensive trading strategy. Open source. Open source software is free and available to anyone to use, modify, and share. It's developed by a community of volunteers who work on it together. Many popular cryptocurrencies, like Bitcoin and Ethereum, are open source. This means anyone can see and change the code. Open source software can be transparent and secure, but it's important to be careful when using it and follow security best practices. Opensea. Opensea is a website where you can buy and sell unique digital assets called non-fungible tokens, NFTs. These NFTs represent ownership of things like art, collectibles, or in-game items. Opensea uses Ethereum blockchain technology and allows you to use Ether or other Ethereum tokens to buy and sell NFTs. It also has tools and features to help you find and sell NFTs. Optimistic Rollup. Optimistic Rollup is a way to speed up transactions on a blockchain by processing some of them off the blockchain. Transactions are first checked by validators, who make sure they are valid. Validators then group the transactions together and add them to the blockchain all at once. This allows for more transactions to be processed without overloading the blockchain. Optimistic Rollup is a new technology and may come with risks. Options are financial contracts that give the holder the right to buy or sell a certain asset at a predetermined price within a specific time frame. Call options allow the holder to buy, while put options allow the holder to sell. Options can be traded on traditional markets and some cryptocurrency exchanges, and are often used to speculate on price movements or hedge against risk. However, options come with high levels of risk and may not be suitable for all investors. Oracles. An oracle is a third-party service that provides external data to a smart contract on a blockchain. Smart contracts are self-executing contracts that are written in code, but can't access external information. Oracles allow smart contracts to interact with the real world by providing access to external data and off-chain information. Oracles are important but can also introduce security risks to the network. Order book. An order book is a list of all the buy and sell orders for a particular asset on an exchange. It shows the current demand and supply for the asset and helps match buyers and sellers. The order book is updated in real time and is an important tool for traders and exchanges. Over-the-counter, OTC. OTC trading is when securities or financial instruments are bought and sold directly between two parties, rather than on a formal exchange. In the cryptocurrency market, OTC trades are often used by large traders looking to buy or sell large quantities of cryptocurrency without affecting the market. OTC trades are facilitated by OTC desks, which offer services like market making and risk management. OTC trading can offer liquidity and anonymity, but also comes with risks like counterparty risk and lack of regulatory oversight. Overbought. An asset is overbought when its price is higher than its value. This may mean the price will fall soon. Technical analysis tools can help identify overbought assets. It's important to consider overbought conditions as part of a trading strategy. Oversold. Oversold refers to when the price of an asset is lower than its true value. This can be a sign that the asset's price may go up. Technical analysis tools can be used to identify oversold conditions. Keep in mind that oversold does not guarantee the price will rise, and it should be considered as part of a trading strategy. Pair. In the context of cryptocurrency, a pair refers to two different assets that are traded against each other on an exchange. A pair can be made up of two different cryptocurrencies or one cryptocurrency and a fiat currency. The price of the base asset is quoted in terms of the quote currency. Pairs are used to buy and sell assets, determine the value of different assets, and hedge against price movements. However, their value can fluctuate significantly due to market conditions and the relative strength of the two assets. Paper trading. Paper trading, also called virtual or demo trading, is practicing trading without using real money. It can be used to test new strategies, learn how to use trading platforms and tools, and gain experience without financial risk. In cryptocurrency, paper trading allows buying and selling virtual assets with simulated prices and conditions. It can be helpful for beginners or experienced traders testing new strategies, but it does not replicate all risks of real trading and should not be taken as a guarantee of future performance. It's important to carefully evaluate risks and potential rewards before applying a strategy in the real market. Parachain. A parachain is a blockchain that connects to a larger blockchain network, helping it handle more transactions. This can improve the scalability and performance of the larger network. Parachains are used in some blockchain networks and offer benefits like faster transaction times and lower fees, but they are still a new and experimental technology with potential risks. Peer-to-peer, P2P. P2P networks are used for exchanging cryptocurrencies directly between people, without a central exchange. They are used in various blockchain networks, including Bitcoin and Ethereum, and are part of the decentralized ecosystem of cryptocurrencies. Peg. A peg in cryptocurrency refers to a fixed exchange rate between the cryptocurrency and another asset, usually a fiat currency. Cryptocurrencies may be pegged to a fiat currency to stabilize their value. Pegs can be created through various methods, including market making and collateralization, and can help reduce volatility in a cryptocurrency. However, pegs also have risks and may not always maintain their fixed exchange rate. Permissionless. Permissionless refers to systems or networks that allow anyone to participate without needing prior approval. In the context of cryptocurrency, permissionless networks are decentralized and allow anyone to join and participate in the network without permission. These networks are used in various blockchain networks, including Bitcoin and Ethereum, and can change how financial transactions are done. However, they also come with risks like fraud and lack of regulation, so it's important to consider the risks and potential rewards before using them. Perpetual contracts. Perpetual contracts, also known as perpetuals or perps, are financial derivatives that allow traders to bet on the price of an asset without owning the asset. In cryptocurrency, perpetual contracts are used to trade cryptocurrencies such as Bitcoin and Ethereum on exchanges. They offer benefits like leverage, the ability to go long or short on an asset, and 24/7 trading, but also come with high risk including potential losses from leverage and price manipulation. Phishing. Phishing is a cyber attack that uses fake emails or websites to trick people into giving away sensitive information, like passwords or financial information. In cryptocurrency, phishing attacks can be used to steal cryptocurrency and other digital assets. To protect against phishing attacks, it's important to be careful about clicking on links or entering sensitive information on unfamiliar websites, use strong passwords, and enable two-factor authentication when possible. Play to earn, also known as play to earn, is a business model where players can earn real value by playing games or engaging with other online content. Players can earn rewards like cryptocurrency or other digital assets by participating in the game or completing certain tasks or achievements. Play-to-earn models are popular in the gaming and cryptocurrency industries and often used in blockchain-based games and decentralized apps. Ponzi Scheme. A Ponzi scheme is a fraudulent investment scheme where returns are paid using the investments of new investors, rather than from any legitimate business activity. These schemes, which are illegal in most countries, promise high returns with little or no risk and use the hype around cryptocurrency to attract new investors. It's important to be cautious about investment opportunities that promise high returns with little risk and to do thorough research before investing in cryptocurrency or other digital assets. Pre-mine. Pre-mine refers to the process of mining a cryptocurrency before it is available to the public. This can create a supply of the cryptocurrency for a small group or for other purposes. Pre-mining can be controversial because it may allow the creators or developers of a cryptocurrency to unfairly benefit from its initial distribution, and may be used to manipulate the price or market. It's important to consider these risks and challenges when considering investing in a pre-mined cryptocurrency, including the potential for price manipulation, disproportionate benefits for developers or creators, and conflicts of interest. Pre-sale. Pre-sale, also known as a private sale or pre-ICO, is the sale of a cryptocurrency or digital asset to a small group of investors before it is available to the public. Pre-sales are used to raise funds for the development of a cryptocurrency or blockchain project and to build a community of supporters. They are often conducted through a private offering, with terms negotiated between the issuer and investors. Pre-sales can offer benefits like discounts on the asset price or future rewards, but also carry risk as the success of the project is not guaranteed and the asset value may fluctuate. Private blockchain. A private blockchain is a restricted distributed ledger technology, DLT, for a specific group of users or organizations. It requires an invitation or permission to join, unlike a public blockchain which is open to anyone. Private blockchains are often used for applications where security is important, such as in finance, or for business applications where a group of organizations need to share data securely. They offer some benefits of blockchain technology but may not have the same level of decentralization or may be subject to censorship by network administrators. Private key. A private key is a secret digital code used to access and spend cryptocurrency. It is generated by wallet software and stored on a device or in a secure offline location like a hardware wallet. The private key is the only way to prove ownership of digital assets and initiate transactions on the blockchain, so it's important to keep it safe and make a backup in case it's lost or stolen. Proof of reserves, POR. Proof of reserves, POR, is a way to verify that a cryptocurrency exchange or financial institution has the assets it claims to have. The exchange provides a cryptographic proof that it holds a certain amount of cryptocurrency in a specific address, which can be verified by anyone with access to the blockchain. POR is often used with proof of solvency, which involves providing a detailed accounting of assets and liabilities. These techniques can increase transparency and trust in the exchange and improve its reputation. Proof of history. Proof of history, POH, is a way to establish a secure record of events on a blockchain. It uses cryptographic hashes to create a tamper-evident record of past events, which can be used to validate the current state of the blockchain. POH is useful for verifying data and transactions, and can be used in supply chain management, asset tracking, and voting systems. It helps improve the security and integrity of blockchain systems. Proof of stake, POS. Proof of stake, POS, is a way for a blockchain network to decide which participant gets to add the next block of transactions to the chain. In polonium-2 sulfide, the chance of being chosen is based on how many cryptocurrency units a participant holds, called their stake. POS is used by some cryptocurrencies and blockchain systems, like Ethereum and Cosmos. It has advantages over proof of work, POW, like being more energy efficient and decentralized. POS helps secure and validate transactions in various blockchain applications. Proof of work, POW. POW is a way to verify transactions and add them to a blockchain. Miners compete to solve a difficult puzzle, and the first to solve it can add the new block of transactions to the blockchain and receive a reward. POW helps secure the blockchain by making it hard and expensive for someone to manipulate it. It has some benefits, like not needing a central authority and rewarding miners, but also has some downsides like using a lot of energy and potentially being controlled by a small number of miners. Public blockchain. A public blockchain is a type of network that anyone can join and use to store and transfer digital assets. It is decentralized, meaning it is not controlled by a single entity, and is maintained by a group of computers called nodes. Examples include the Bitcoin and Ethereum blockchains. Public blockchains offer transparency and security and are used for various applications such as financial transactions and supply chain management. Public key. A public key is a code used to receive cryptocurrency. It is linked to a private key, which is used to access and spend the cryptocurrency. Public keys are stored in wallets and used to create a digital address that other users can use to send cryptocurrency. They are important for securing and protecting digital assets. Public sale. A public sale is when a new cryptocurrency or token is available for anyone to buy. It's a way for a project or company to raise money and get attention by selling some of their tokens. Public sales happen online and anyone can participate. They can be risky for investors because there's no guarantee the project or company will be successful or that the value of the tokens will go up. Regulation. Regulation is the oversight and control of cryptocurrency by governments and regulatory bodies. It is put in place to protect financial stability, consumers, and prevent money laundering and terrorism financing. The level of regulation varies by country. It is intended to ensure that cryptocurrencies are used responsibly and in compliance with existing laws. REKT. REKT is slang used in the cryptocurrency community to describe someone who has suffered significant financial losses due to poor investment decisions or market volatility. It is not meant to be taken literally and is often used in a humorous or sarcastic way. Relative Strength Index, RSI. The Relative Strength Index, RSI, is a tool used to measure the strength of a cryptocurrency's price. It shows if a cryptocurrency is overbought or oversold based on past performance. The RSI is plotted on a scale from 0 to 100. A value above 70 means the cryptocurrency is overbought and may be a good time to sell. A value below 30 means the cryptocurrency is oversold and may be a good time to buy. The RSI is just one tool and should not be used alone. It is also a lagging indicator, meaning it may not accurately predict future price movements. Relay chain. A relay chain is a type of blockchain that connects different networks and allows them to communicate and exchange assets. It helps different networks work together and can be used to transfer assets without intermediaries. Roadmap. A roadmap is a plan that shows the goals and steps a cryptocurrency project or company will take to achieve them. It includes details about the project's target audience, technology, timeline, and partnerships. Roadmaps help projects communicate their plans and progress to the public and build trust. They also provide insight to investors. ROI. ROI is the profit or loss made on an investment. To calculate ROI, divide the profit or loss by the initial investment amount. It is expressed as a percentage and helps measure the profitability of an investment and compare different investments. In cryptocurrency, ROI is the profit or loss made from buying and selling it. Past performance is not necessarily indicative of future results, and investing in cryptocurrency carries risks. Rug pull. A rug pull is a scam in the cryptocurrency market where a group manipulates the price of a cryptocurrency and then sells their holdings, causing the price to crash and investors to lose money. It can be difficult to detect and prevent, as it often involves fake social media accounts and websites to promote the scam. It's important for investors to be cautious and do research before investing in cryptocurrency. Rust. Rust is a programming language used to create decentralized apps, DApps, and other blockchain systems. It is efficient and secure, making it ideal for building complex and resource-intensive applications that run on the blockchain. Rust is used by popular cryptocurrency projects such as Parity, Whisper, and 0x. Standard & Poor's 500, S&P 500. The S&P 500 is a stock market index that tracks the 500 largest publicly traded companies in the U.S. It is used as a benchmark for the performance of the stock market and is not directly related to cryptocurrencies. It is a widely recognized and respected index that is used to measure the overall health of the economy. Satoshi, Sats. Satoshi, Sats, is a unit of Bitcoin, the world's first and most well-known cryptocurrency. It is named after the person or group who created Bitcoin, known as Satoshi Nakamoto. 1 Satoshi is equal to 0.00000001 Bitcoin, which is often called a base unit of the cryptocurrency. The value of a Satoshi is based on the value of Bitcoin and can change over time. Satoshis are abbreviated as sats and are used to represent small amounts of Bitcoin. Satoshi Nakamoto. Satoshi Nakamoto is the name used by the unknown person or group who created Bitcoin. They also wrote a paper explaining how it works. Satoshi Nakamoto's true identity is unknown and has never been revealed. They are credited with inventing the concept of Bitcoin and developing the technology behind it, which is based on a decentralized and distributed ledger called the blockchain. Despite their significant contributions, no one has been able to definitively prove who is behind the pseudonym. Scam. A scam is a trick used to steal money or assets. In the context of cryptocurrencies, scams can be different types of fraudulent activity, such as phishing attacks, Ponzi schemes, or rug pulls. Cryptocurrency scams often use fake websites or social media accounts to promote false investment opportunities. It's important to be careful and do research before investing in cryptocurrency. Scams can be difficult to spot, so it's important to be cautious and not trust too easily. Scammer. A scammer is someone who tricks people into giving them money or assets by pretending to offer a legitimate investment or opportunity. In the cryptocurrency market, they may use fake websites or social media accounts to promote their scams. It's important to be careful when considering investing in cryptocurrency and to do research to avoid scams. Scrypt. Scrypt is a type of computer function that is used to secure certain cryptocurrencies. It makes it hard for certain types of mining hardware to attack the network and helps keep the mining process decentralized. It is used by some cryptocurrencies, including Litecoin and Dogecoin, as well as some initial coin offerings, ICOs. Second-layer solutions. Second-layer solutions are technologies that improve blockchain performance and functionality by operating outside of the main blockchain. They can enable faster and cheaper transactions, and add new types of applications or functionality. Examples include the Lightning Network for Bitcoin and the Ethereum Virtual Machine. Secure Asset Fund for Users, SAFU. SAFU is a fund created by Binance to protect users in case of a hack or security breach. It is kept offline and is used to reimburse users and cover losses in the event of an incident. It is funded by Binance's profits and is intended to provide an extra layer of protection for users. Secure Multi-Party Computation, sMPC. Secure Multi-Party Computation, sMPC, is a way for multiple parties to perform a function without sharing their input data with each other. This can be used in cryptocurrency systems to enable private transactions or to perform complex computations. sMPC can be used to prove the validity of a transaction without revealing the underlying data, and can also be used in decentralized systems like smart contracts and decentralized applications. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is a U.S. government agency that regulates the securities industry, including the trading of stocks and other securities. The SEC also has the authority to regulate cryptocurrencies that are considered securities, and has issued warnings and taken enforcement actions to protect investors from fraud and manipulation in the cryptocurrency market. The SEC has also issued guidance on the regulation of initial coin offerings, ICOs, which may be subject to securities laws depending on the specific circumstances of the offering. SegWit. SegWit is a change to the Bitcoin network that helps improve its scalability and transaction processing. It increases the block size, reduces fees, and speeds up transaction times. It also adds security and supports new types of transactions and features. SegWit separates the signature data from the rest of the transaction data in a block to make more space for transactions. It has been widely adopted and has helped improve the performance of the Bitcoin network. SHA-256. SHA-256 is a type of mathematical algorithm that helps to secure data and verify the authenticity of a message or file. It is commonly used in cryptocurrencies to secure the blockchain and verify transactions. SHA-256 creates a unique output, called a hash, based on the input it receives. It is secure and widely used for secure data transmission and authenticating digital certificates. Sharding. Sharding is a way to speed up the performance of a cryptocurrency network by dividing the data and workload among multiple nodes instead of just one. This can make the network more efficient and able to process more transactions. There are different approaches to sharding, and it is being researched to see if it can solve the scalability problem of some cryptocurrency networks. However, it is a complex area and there are still challenges to be addressed. Shilling. Shilling is when someone promotes a cryptocurrency or project, often to increase its value or popularity. Shilling can be either genuine or fraudulent. Legitimate shilling is when someone believes in a cryptocurrency or project and wants to share their enthusiasm. Fraudulent shilling is when someone promotes a cryptocurrency or project to manipulate its price or reputation for their own benefit. Shilling can be problematic as it can create a false impression of the value or popularity of a cryptocurrency or project, leading to investment decisions that may not be based on accurate or complete information. Shitcoin. A shitcoin is a cryptocurrency that is believed to be worthless or a scam. It may have poor performance, little adoption, or be associated with fraudulent practices. The term is subjective and not a formal classification. Shorting is a way to bet against the price of a cryptocurrency by selling it when you don't own it. You borrow the cryptocurrency, sell it on the market, and then buy it back at a lower price later to return it to the lender and make a profit. It requires a platform that supports margin trading and carries additional risks. Short squeeze. Short selling is when you sell a cryptocurrency that you don't own, hoping the price will go down. When the price goes up instead, traders who shorted the asset lose money. A short squeeze happens when the price of a heavily shorted asset suddenly goes up, causing traders to buy it back at a higher price to cover their positions, leading to even more price increases. This can be risky for traders who shorted the asset, as they can lose a lot of money if the price goes up unexpectedly. Sidechain. A sidechain is a separate blockchain that is connected to a main blockchain. It allows assets to be transferred between the two chains and is used to add new features or capabilities to a blockchain without modifying the main blockchain. Sidechains can also be used to make different blockchains work together. Signal. Cryptocurrency signals are pieces of information or recommendations that suggest what trades or investments to make in the cryptocurrency market. They can come from various sources, such as trading platforms or analysts, and may be free or paid. It's important to be careful when evaluating cryptocurrency signals and to do your own research before making decisions. Silk Road. Silk Road was an online market that sold illegal goods and services using Bitcoin. It was operated by Ross Ulbricht and was shut down by law enforcement in 2013. Ulbricht was arrested and is now serving a life sentence. Silk Road was one of the first examples of the use of cryptocurrencies for illegal activities and highlighted the risks and difficulties of tracking and prosecuting crimes involving cryptocurrencies. Simple Agreement for Future Token, SAFT. SAFTs are agreements that let companies raise funds for new cryptocurrency projects by selling tokens to investors before the tokens are available to use. SAFTs set out the terms of the sale, including the price and timeline for distributing the tokens. Some people think SAFTs provide a clear and regulatory compliant way to fund projects through initial coin offerings, ICOs, but others say they may be considered securities and subject to securities laws. It's important for companies and investors to carefully consider the legal and regulatory implications of SAFTs before entering into them. Slashing. Slashing is a way to punish nodes, participants in a cryptocurrency network, that do harmful or irresponsible things, like trying to manipulate the network or committing fraud. The punishment, which can be a temporary or permanent ban or a reduction in the node's stake, amount of cryptocurrency it holds, helps maintain the security and integrity of the network. Slippage. Slippage is the difference between the expected price of a trade and the actual price at which it's executed. It can happen when the market is volatile or there's a big difference in supply and demand. It can cause unexpected losses or reduced profits for traders. To minimize risk, traders may use limit orders or other strategies. It's important to be aware of slippage in volatile markets and adjust strategies accordingly. Smart contracts. Smart contracts are digital contracts that are stored on a blockchain and can automatically execute when certain conditions are met. They help automate and secure certain types of transactions and can be used in many industries. Smart contract audit. A smart contract audit is when someone checks and evaluates the code and terms of a smart contract to make sure it's secure, accurate, and works properly. It's usually done by a third party to identify any problems or vulnerabilities with the contract. Smart contract audits are important to ensure the security and reliability of the contract and can include code review, functional testing, and security testing. They help make sure smart contracts are secure and reliable. Snapshot. Snapshots in cryptocurrency are used to record the state of a blockchain at a specific point in time. They can be used to track the distribution of tokens or coins, or to create a new cryptocurrency based on the state of an existing blockchain. Snapshots are useful for tracking ownership and distribution, and for creating new cryptocurrencies with different rules. Soft cap. A soft cap is the minimum amount of funds that a cryptocurrency project aims to raise. It is often set lower than the hard cap, which is the maximum amount of funds the project aims to raise. If the project doesn't reach its soft cap, it may need to adjust its plans or cancel the fundraising event. The soft cap helps ensure the project has enough funding to continue development. Solidity. Solidity is a programming language used to write smart contracts for the Ethereum blockchain. It is a compiled language that allows developers to write complex rules and logic for smart contracts on Ethereum. There is a large community of developers and resources available for learning and using Solidity. It is an important tool for those working on Ethereum. Source code. The source code is the programming language used to create a cryptocurrency or blockchain app. It defines how the system works and what it can do. The source code is usually public and open source, meaning anyone can see and use it. This helps ensure the code is secure, reliable, and transparent. It's an important part of any cryptocurrency or blockchain app. Spot. The spot price of a cryptocurrency is the current market price. It's the price at which a cryptocurrency can be bought or sold at a given time and reflects supply and demand. Spot trades involve buying or selling a cryptocurrency at the current market price, as opposed to futures or options trades that involve buying or selling at a future date or predetermined price. Spot trades are typically settled on the spot, meaning the buyer and seller exchange the cryptocurrency and funds at the time of the trade. The spot price is important for traders and investors when making decisions about buying and selling cryptocurrencies. Spot market. The spot market is a place where you can buy or sell cryptocurrencies at their current price. It's the most common place for trading cryptocurrencies and has lower fees and more liquidity than other markets such as futures and options, which are used for trading at a future date or price. The spot market is influenced by various factors like demand and regulatory changes. It's an important part of the cryptocurrency market. Spot trading. Spot trading is buying and selling cryptocurrencies at their current market price. It's the most common way to trade cryptocurrencies, and it's typically done through a spot market, which has lower fees and higher liquidity than other markets like futures and options. Stablecoin. A stablecoin is a type of cryptocurrency that has a stable value, often by being linked to a stable asset like a currency or commodity. The purpose of a stablecoin is to offer a more steady and predictable value compared to other cryptocurrencies, which can be very volatile. There are different types of stablecoins, including ones that are fully backed by the underlying asset, partially backed, are kept stable through algorithms. Stablecoins have become more popular because they can provide a stable value and have many potential uses such as storing and transferring value, making payments, and protecting against cryptocurrency price changes. Staking. Staking is the process of holding or locking up a certain amount of cryptocurrency to participate in the operation of a proof-of-stake blockchain network. By staking their cryptocurrency, users can earn rewards for helping to secure the network and validate transactions. Staking is an alternative to mining and is used in proof-of-stake networks to validate transactions and add new blocks to the blockchain. It is more energy efficient than mining, which is used in proof-of-work networks. Staking pool. A staking pool is a group of people or organizations that combine their cryptocurrency resources to validate transactions and earn rewards on a proof-of-stake (POS) blockchain. By joining forces, they increase their chances of being chosen to validate transactions and earn rewards. Staking pools may offer technical support and infrastructure for staking cryptocurrency and may divide rewards among members. They can increase participation in a POS network and support its security, but it's important to carefully evaluate the terms and risks of joining a staking pool. State channel. State channels are private channels between parties that allow them to conduct multiple transactions without each one being verified by the network. These channels use a smart contract to define the terms of the transactions and can be closed to broadcast the final state to the network once all transactions are complete. State channels improve the speed and efficiency of transactions and have potential uses in DeFi, micropayments, and other areas. Stop-loss order. A stop-loss order is a way to sell a cryptocurrency if it drops to a certain price, to limit potential losses. It's a risk management tool used by traders and investors. It's important to note that it doesn't guarantee losses will be avoided. It's a useful tool to help manage risk in the cryptocurrency market. Storage node. A storage node is a computer or device that stores a copy of a blockchain and helps a decentralized network work. Storage nodes may validate transactions, add new blocks to the blockchain, or store and serve the blockchain to other nodes or users. They need a lot of storage space and bandwidth, a secure connection, and may be run by individuals or organizations as a contribution to the network or by businesses as a service. Storage nodes are important for the operation and security of decentralized networks. Store of value. Cryptocurrency is a digital asset that is used as a medium of exchange or a store of value. A store of value is an asset that maintains its value over time and can be used to preserve wealth or as a means of exchange. Some cryptocurrencies, such as stablecoins, are designed to be stable stores of value by being pegged to a stable asset like a currency or commodity. However, many cryptocurrencies are highly volatile and have not yet proven to be stable stores of value. It is important to consider the store of value potential when evaluating cryptocurrencies. Supply chain. Cryptocurrencies and blockchain can make supply chains more efficient and secure by using a decentralized ledger to track the movement of goods and services. This technology can automate transaction tracking, reduce the need for intermediaries, and improve communication between supply chain partners. The use of cryptocurrencies and blockchain in the supply chain has the potential to bring significant benefits and efficiencies. Swing trading. Swing trading is a trading strategy where you hold positions for a few days to a few weeks to profit from short-term price movements. It's riskier than other strategies because you're exposed to more price fluctuations over a longer period of time. Swing traders use technical analysis and other tools to identify trades and decide when to enter and exit the market. It can be a good strategy for those who can handle higher risk and have the time and resources to monitor the market. Sybil Attack. A Sybil attack is a type of attack in which an attacker creates and controls multiple identities in a decentralized network, such as a blockchain, in order to gain an unfair advantage or manipulate the network. This can threaten the trust and integrity of the network and requires measures, such as proof of work or proof of stake, to protect against. Synthetic asset. Synthetic assets are digital representations of other assets that can be traded on platforms like DeFi. They offer access to hard-to-trade assets and flexible trading strategies but can carry significant risks, including default and regulatory scrutiny.